All right, welcome to The Explainer. Today, we're going to break down a massive, and I mean massive, bet that a very savvy investor just made on one of the world's biggest financial players. This is more than just buying a stock, it's a fascinating strategy that tells us a whole lot about where the smart money thinks our economy is headed.
Okay, let's just jump right in with the most important number on the screen, $1.4 million. That's how much cash an investor just collected instantly. This wasn't a future profit or a capital gain. This was cold, hard cash paid directly into their account, right up front.
So how did they get that cash? Well, it came from a pretty complex options trade that, when you boil it all down, is a huge bet that Blackstone's stock won't crash over the next 3 years. So the real question is, why would somebody make such a massive, long-term wager with so much confidence? That's what we're going to dig into.
To really get the why behind this, we first have to understand the how. It's super important to know this investor didn't actually buy anything. Instead, they sold a promise. Think of it like they're selling insurance on Blackstone's stock.
Okay, so here are the nuts and bolts of the trade. They sold what's called a put option. Basically, they made a promise. They said, hey, I will buy 100,000 shares of Blackstone at $100 a share anytime over the next 3 years. And just for making that promise, for taking on that potential obligation, they got paid $14 a share, which is where that $1.4 million comes from.
And this is where it gets really clever. You see, because they collected that $14 premium for every share right away, they don't start losing money if the stock hits $100. Nope. Their actual break-even price is way down at $86. The stock has to absolutely crater, fall almost 40% from where it is now before they would lose even a single penny. That is a massive, massive cushion.
And just think about the timeline we're talking about here. This isn't some quick in and out trade. We're talking 1,045 days. That's almost 3 full years for their big idea about this company to play out. They are clearly not worried about the day-to-day noise of the stock market. So, what on earth gives someone the confidence to put that much money on the line for that long? Well, it's definitely not a guess. It's a thesis, and it's built on the incredible fundamental strength of Blackstone's business, which, as you're about to see, is kind of like a financial fortress. It really all starts right here. Blackstone is an absolute giant. They're managing over $1 trillion in assets. But here's the key. Look at that perpetual capital number. That's over $500 billion that's basically locked in, generating steady, predictable fees year in and year out, no matter what the market is doing. That's the bedrock of this whole bet.
And this is really the secret sauce to their business model. Think of it in 2 parts. On one hand, you've got these fee-related earnings. That's the super stable, almost boring recurring paycheck they get just for managing all that money. Then, on the other hand, you have the distributable earnings. This is where things get really exciting. This includes the massive performance fees they get when their big investments pay off. So you've got this incredible foundation of stability, plus this huge potential for explosive growth.
Now let's talk real estate, because for a while this was a big worry for the market. But now, the tables have completely turned. Why? Well, for starters, nobody's building new stuff. New construction has fallen off a cliff. That means less competition and, you guessed it, higher rents for the buildings that already exist. And we're not talking about half-empty office towers here. Blackstone is all in on the hottest areas, like giant warehouses for e-commerce and massive data centers.
And it's not just real estate. They've quietly become this lending juggernaut. But look at how unbelievably safe their lending is. Over 20 years, their annualized loss rate is 0.08%. That's practically nothing. They're getting great returns without taking on the crazy risks you see with traditional banks. It's just a stable, cash-generating machine. So, the business is stable, it's a fortress. We get it. But this bet isn't just about playing defense. It's about a massive offensive play, positioning themselves to ride what is probably the single biggest economic wave on the entire planet right now. And this right here is the core belief driving everything. Blackstone is convinced, and they're putting billions of dollars behind this belief, that AI is fundamentally rewiring the entire global economy. It's not just another trend, it's a tectonic shift, and they plan to be right at the center of it. But here's the genius part. They're not gambling on which hot new AI startup is going to win. That's a sucker's bet. Instead, they're building the infrastructure, the toll roads of the AI revolution. They're buying up the physical stuff that AI absolutely needs to function. The data centers, the power grids, the energy sources. Every tech giant, from Google to Amazon, has to pay them rent, in a way. They're the landlord for the entire AI boom. So you've got this incredible AI tailwind pushing them forward. But as if that wasn't enough, there's a huge change coming from Washington that could literally unlock a river of new cash. We're talking trillions of dollars flowing right into Blackstone's funds.
This is a really big deal. You know your 401k? Well, for your entire life, it's been pretty much blocked from investing in these kinds of private deals. But that's all about to change thanks to a new executive order.
Just think about the scale of this. We're talking about giving over 90 million Americans the chance to put their retirement money into these kinds of assets for the very first time. That could mean trillions in new capital looking for a home, and a huge chunk of that is going to land right at the feet of firms like Blackstone. And look at the timing. They expect meaningful inflows by 2027, which fits perfectly inside the 3-year window of this trade.
Okay, so let's take a step back and put all the pieces of the puzzle together. You've got the rock-solid business model, you've got this massive AI growth story, and you have a regulatory change that's about to open the floodgates of new money. So what does this $1.4 million bet really tell us?
It shows that this isn't some crazy high-risk gamble. It's a really sophisticated strategy. The fancy term is strategic volatility arbitrage, but here's what it means in plain English. You're getting paid to bet that a company's real, long-term strength is worth more than the market's short-term fears. You're basically harvesting cash from that disconnect.
And this belief isn't just based on hope, it's protected by layer after layer of defense. I mean, that break-even price is way down at a level we haven't seen in years. The stock's recent low is still miles above the $100 price they'd be forced to buy at. They have that huge base of fee-earning assets pumping out cash no matter what. And you know, if the price did start to fall, the dividend would get so juicy that new buyers would likely rush in. It's a fortress with a moat and multiple walls.
Which really leaves us with one final big question. This investor is getting paid to underwrite the essential infrastructure of our future. The data centers, the logistics, the power grids. In a world that's only getting more complex and more digital, you really have to wonder, is the real risk betting against all of that?